Hello everyone. So I'm back again with another interesting topic, which is Forex, Foreign Exchange Reserve. So we'll be decoding what is a Forex and how it will impact our Indian economy. So these days you are hearing that the Forex Reserve of India has gone down so much. So I thought of coming up with this video wherein you will understand all the fundamentals related to this topic of foreign exchange reserve, and obviously how this topic is so much related to the stock market and probably the returns you are expecting from the market. As always, I have tried to include all the important points related to this topic. I request you to watch the video till the end because I have included many interesting points related to this topic and also some other things which are indirectly related to this topic as well.
The foreign exchange reserves are adequate. Third, in recognition of the fact that there is a genuine shortfall of supply of forex in the market relative to the demand because of import and debt servicing requirements and portfolio outflows, the Reserve Bank has been supplying US dollars to the market to ensure that there is adequate forex liquidity. After all, this is the very purpose for which we had accumulated reserves when capital flows were strong.
So Forex, foreign exchange reserve, is basically the foreign reserve of a country held in liquid form by central bank of that particular country as an insurance against financial shocks. So you know the Central Bank of India is Reserve Bank of India, RBI. So we will concentrate or limit our topic to RBI. So RBI, in that case, a central bank of that country, uses this foreign reserve to back the exchange rates of the currency and also utilizes them in case the capital inflow into the country is low and is not able to finance the current account deficit of the country. Current account deficit is the difference of exports to imports to a country. So if a country, say India, has more imports than exports, which is the real case, so we have a deficit. But if in case, say, other countries, developed nations, wherein the exports are more than imports, they have a current account surplus. So before getting into the details of Forex, let me first tell you what are the components of Forex. So the foreign exchange reserve is mainly composed of four components. First is obviously the foreign currency. Second is gold. Third is special drawing rights of IMF. And the last is reserve trench position. Don't worry, I will be explaining all the four items in detail. So first item is foreign currency assets. So this mainly contributes 80% of India's forex. So foreign currency assets mainly includes the investment of RBI into bonds of other countries like USA. So these investments are mainly into safe assets like treasury bills of US. So almost 2/3 of the foreign currency assets are invested in US treasury bonds. 2/3 of the foreign currency assets is invested mainly into US securities and bonds. And rest of the foreign currency assets are invested in securities and bonds of Euro, Pound, Australian dollar and Japanese yen. Rest of these foreign currency assets is invested in other central banks and some foreign commercial banks. The second component of Forex, as I told, is gold. So gold is more resilient to various financial or external shocks, but still gold is only a small portion of the Forex. As I told, the foreign currency assets form majority of the Forex, which is like 80% in case of RBI. The third component is SDR, which is the special drawing rights. So special drawing right is made by IMF, the International Monetary Fund, in 1969. These are international reserve currency which can be utilized by the particular country as soon as it joins the IMF. So these are not real currency, these are paper currency which can be utilized by the particular country as per the quota allocated to that particular country if in case of a need. So basically these papers under SDR can be converted into real currency in case of a need by the country. So the currencies to which it can be converted are dollar, yen, yuan, pound and euro. These are the five international currencies to which it can be converted into. And the fourth one is reserve trench position in IMF. So based on the quota of the particular country who joins the IMF has to give some money to IMF as a reserve, and if in case of a need, the country can withdraw that amount without any interest in case of an emergency, which is the RTP. Now if you get into the real figures of India's foreign exchange reserve, Indian forex dropped by around $104.5 billion from $642 billion in September 2021 to around 537.52 billion US dollar as on 23rd September 2022. So it's a huge drop from that earlier $642 billion forex reserve. Again, if you see before that September 23rd week, the earlier week, the forex reserve was at 545.65 billion US dollar. That again dropped to 537.52 billion US dollar in the next week. That is how the huge selling by the foreign investors are happening, and the forex is depreciating. And also the US dollar appreciation is impacting the forex reserve value. If you see the 2008 financial crisis, at that time India had lost $70 billion forex reserve. So what all are the conditions or situations wherein the forex can increase? One is when foreign direct investments in stocks and bonds of India increases, this will increase the foreign exchange reserve. You may see my earlier video on FII selling and you will get great insights on this. Also lower domestic consumption, especially wherein we had a COVID pandemic at its peak. So there was no much greater domestic consumption. So this will reduce the imports, and in fact this has reduced the imports to India at that time, and this also help increase the forex. Also when Indian companies go outside, especially outside India, and they take credit when the interest rate were low, especially during COVID times, so they are bringing in money into India as they were getting the credit at a lower interest rate. So this also has increased the forex. Obviously, lower crude oil price has really helped increase the forex. So there are other cases wherein the forex reserve, as I mentioned earlier, will increase when the foreign investors invest in India, especially FDI, which are more durable. Regarding FDI, FPI, etc., I have explained in my FI selling video. So I request you to go to that video as well, so that you understand the concepts very well. Also, this FPI, once they invest in bonds, this also increases our forex. It can be bonds and stocks. Also, an increase in exports helps increase the forex, because the foreign currency is coming inside, which will increase the forex reserve. NRI remittance is another way by which the forex increases. So the people going outside, if they send the money from there in their currency, in the local currency, in the local foreign currency, and sends to India, so this is again an increase to the forex. Multilateral loans by government also helps increase the forex. Money allocated by foreign banks to India also helps increase the forex. This is like World Bank, ADB Bank, JICA Bank of Japan, etc. for various spending of India, like infrastructure projects, metro projects, bullet train, etc. So money comes in dollar, but the spending in India for such projects is in rupee only. So rupee, equivalent amount of rupees definitely spent for the projects in India, but whatever foreign currency comes in is stored by RBI under the forex. So probably, as you may be thinking earlier, that forex is something like US dollar loaned off to India. It's not like that. So as I told, this will be investments by RBI into US treasury bonds and other securities. Now let's talk something about rupee depreciation, weakening of rupee, which you are hearing a lot these days. So this rupee depreciation is mainly gauged by REER, real effective exchange rate. Here, while calculating this REER, we are comparing our Indian rupee INR with 6 major currencies and also other 36 other currencies. So if the REER is less than 100, then it's considered a weaker currency, and if the REER is above 100, then it is considered overvalued. So weaker currency means it is good for exporters, and a overvalued currency means it is less attractive for exporters. Now let's discuss why forex has been continuously decreasing in India these days or in a year. So RBI has been selling this forex US dollar openly in the market, as the rupee had been depreciating continuously, added by higher crude oil price. The trade deficit of India has been multi-year high because of the increasing crude oil price, rising imports of gold, crude oil, fossil fuels like coal. Second is heavy FI selling because of the recession fear in US. So this also has depreciated our forex reserves. So third is risk aversion. So foreign institutional investors or foreign investors has been continuously pulling the money because the interest rates are increasing there. So they want to invest in safer assets like gold and bonds, wherein they get slightly higher return, but they are purely risk free compared to very high risky equities. Fourth one is the buy and sell swap transaction by RBI in currency market. Almost 15 billion US dollar has been sold off by RBI this year in these transactions. The higher inflation rates in UK, US has led to increase in the interest rates by various central governments of these respective countries. This has led to lesser spending due to increased cost of borrowing. This has led to lesser imports. Lesser imports by these developed countries means lesser exports from emerging countries like India. So this has led to reduced exports by India, leading to higher current account deficit. As I told, if the exports go slow and the imports are increasing, the current account deficit increases. So if you see in 2012 October December quarter, the current account deficit has been the highest. Now the current account deficit in July September quarter is 5.61% of GDP, which is very alarming. Earlier quarter it was only 2.1% of GDP, but in the next quarter, which is this July September quarter, it has almost more than doubled, which is 5.6% of GDP. So if you see, as per the guidelines, if the current account deficit as percentage of GDP is greater than 2%, it is uncomfortable. And as you see, currently it is 5.61, which is highly unaffordable. Also, it is to be noted that, as I mentioned, the forex reserve currently is around 537 billion US dollar. If the forex of India goes below $500 billion, this is worrisome for RBI. Because as you know, as I mentioned in the session, this forex reserve is actually a contingency reserve by RBI for various financial crises. So they cannot afford the forex to go beyond some levels, whose threshold being $500 billion. So reiterating, as you have seen in my session, foreign exchange reserve is not a liquid cash, which is the savings of India, available for free spending by India, but it is divided into these 4 items to which the forex is allocated. So let me talk about uses of forex. So I have told that how RBI uses it, but let me decode it further, specifically how the forex is being utilized by RBI. So as I told, for imported goods, you have to pay in the foreign currency. So if at all the country, because of some reason, doesn't have enough currency with us, foreign currency with us, because of the lesser imports, then to pay in foreign currency, this reserve, foreign currency reserve of RBI can be utilized. Because of the higher current account deficit, as I mentioned, there is a lesser export. So lesser export means lesser income of foreign currency. So we may fall short of foreign currency. So in that situation, this foreign currency from the foreign currency reserve of forex of RBI is being utilized. The main thing is that RBI should have 9 months of foreign reserve to be spent to have a smooth import. So if the threshold of that 9 months is fallen below, which I told is below $500 billion, it is really alarming for RBI. As I told regarding the currency exchange rate, so if, as you know, the Indian rupee has depreciated a lot to dollar and now it is standing at around 82 rupees, 81.5 rupees. So to stabilize INR value and not to allow the INR to go beyond some threshold limits, RBI has been selling the forex, basically the dollar, in open market and buying rupee, so that the demand of rupee doesn't depreciate much, and also this helps appreciate the rupee to the dollar. So if you take a stock of highest foreign exchange reserve, first comes China, then comes Japan, then Switzerland, then Russia, and guess what? 5th position is India. And then comes Taiwan and Hong Kong. Recently, RBI has come up with international trade settlement in INR as well.
The Reserve Bank of India today said that it has put down in place a mechanism to settle international trade, or in simpler terms, rather, import-exports in rupees. According to the statement released by the central bank, under this mechanism for international trade settlements in rupees, banks will need to seek prior approval to use. The central bank's move, which it said was to promote growth of global trade and to support increasing global interest in the rupee. The move comes amid increasing pressure on the Indian currency in the wake of Russia's invasion of Ukraine.
So this is somewhat huge positive to Indian market, especially for INR. So as you know, for normal international trades, all countries, including India, is using the SWIFT network. So SWIFT network is having lot of banks involved, and all the transactions are done in dollar. So if a company in India has to do a trade in another foreign nation, so they have to use this SWIFT network. For this, let me give you an example. Say a company Nava Limited, which is in India, has to import manganese ore worth 90 lakhs INR from a company named ABC Limited in South Africa. So this Nava Limited has to give Indian bank 90 lakhs INR and ask them to pay equivalent currency in dollar to the American Bank of India. Then the Indian bank will tell American bank to transfer 90 lakhs equivalent of dollar to the American Bank of South Africa, which is located in US. As the South African bank is having its account in American bank in US, and as they have got 90 lakh equivalent in US dollar, this South African bank in South Africa will pay equivalent South African rand to the South African rand being the local currency of South Africa. So will pay equivalent South African rand to company ABC Limited in South Africa. So this is how this 90 lakhs from India is transferred to South African company ABC Limited. So there are a lot of transactions, lot of two American banks and lot of banks involved in this, and there are a lot of commissions by each of the banks. So this is a highly complex network. So this SWIFT network has got almost 11,000 banks worldwide. This network is managed by highly sophisticated messaging network called SWIFT. The main issue here to be noted is that the SWIFT network is controlled mainly by US and Europe. More than 50% of the international trades are done through SWIFT network. So if US and Europe has got any issue with some of the country, say Russia, they can impose sanctions. Sanctions is like prohibitions on the trades, and whatever reserve they are having with that particular American bank, that gets blocked. So this has happened in this Russia-Ukraine war. While this Russia-Ukraine war, wherein almost $300 billion reserve of Russia in American bank is being blocked, and this has really impacted the trades of Russia. So this SWIFT network, as I told, is mainly dominated by US and European nations. So they can easily stop the trades. Like they have sanctioned the imports of crude oil to other nations, but they have not sanctioned much on the exports of Russia to European countries, because European countries, if the Russian gas is not given to European countries, as you know about Nord Streams, this will lead to increase in gas price and huge inflationary pressure in these European countries. So Western countries, as the Europe is dominant on SWIFT network, don't sanction the gas exports to Europe, but to other countries. So there is some partiality in this sanctioning because the SWIFT network is governed by these two major nations. So while this sanctioning has happened, India is also unable to do trades with Russia. So to counter this, India has come up with an alternative system to bypass this SWIFT network. So this trade bypassing SWIFT network is done through something called Vostro account. Again, to state an example, a Russian company wants to do a trade transaction with an Indian named, say, Bijoy, without SWIFT network. So Russian company will have Russian bank with money stored in ruble. Ruble is the local currency of Russia. And this Russian bank will also have its account in India, in an Indian bank, with its equivalent money stored in INR. This Indian bank account is called Vostro account. Vostro account is nothing but bank's bank account held by a foreign bank. Now say Bijoy want to import crude oil worth 1 crore from Russian company named DEF Limited. So Bijoy will pay 1 crore to Russian bank account in Indian bank, which is also called Vostro account. After currency conversion rates and commissions, Russian bank in Russia will pay the DEF Limited in equivalent ruble. And the trade, if the DEF Limited wants to do another trade with Bijoy, so the vice versa happens through this Vostro account. Now regarding this Vostro account and trading in INR, the main advantage is that India will be able to do bilateral trade of around $13 billion with Russia. I have been mentioning bilateral trade here and there. So bilateral trade is nothing but exchange of goods between two nations promoting trades and investments. The two countries would reduce or remove taxation, import quotas, export constraints, and other trade barriers to encourage trade and investment between these countries. So we would get goods at a cheaper rate as offered by Russia, especially during this war condition wherein sanctions has been applied upon Russia by US and West. So this has been advantageous for us, especially for crude oil, cheaper crude oil imports and all. You must have read in the news. Also, we can do through Vostro account, we can do trades with other sanctioned countries as well, like Venezuela and Iran. So again, there is a possibility of getting cheaper crude oil rates from these countries who are also into crude oil exports. UAE is also in the list, so we can do trades with UAE as well through this account. Only disadvantage is that this we are bypassing the SWIFT network, which is dominated by US and Europe. So US, we are having bilateral trades of around $119.42 billion. This has surpassed China as well. So this is a big value compared to $13 billion with Russia. So if US is not happy about this, then they can apply sanctions on us as well. So this is one threat. But hopefully we can have a greater amount of trades going forward with Russia and other countries, and our dependence on US may be reduced. So hope this session on Forex and its impact on Indian economy, how RBI manages the Forex, and also international trade settlement of INR, all these things you learned well. If you have any doubts, you can comment me in the comment box below. If you like the content, please like and subscribe to my channel. See you in the next video. Till then, happy investing.